right here. Okay, so welcome again, guys. Sorry for the little hitches we're having here. Right. Okay, so basically today what we're going to be looking at is, what is popularly known as risk management. Risk management. I mean, it is very important that you understand this. You'll find that a lot of traders, a lot of newbie traders, go into Forex, wanting to hit the jackpot. And, it is the case that it's either because they are just being plain greedy, or perhaps because they have a gambler mentality, or perhaps they just don't know any better. That's simply what it is. It's either one of all those three things I've mentioned, or perhaps all three. So it is important that from the beginning you understand lot sizes. You understand lot sizes. Obviously, if you are going to be entering a trade, you are going to decide, or you're going to have to use one of three lot sizes, either a micro lot size, a mini lot size, or a standard lot size. Obviously, if you have a big account, then it's understandable if you use a standard lot size. But even then, there are lots of people who have a big account but decide to stick with either mini or micro. I mean, to be honest with you, if you have a big account, and I suppose even that is relative, when you say big, what is big? How big is big? For some people, $250, capital is big. For some other people, 5,000 is what they consider big. For others, it's 1,000. Okay, so within reason, let's say, for instance, you have a $1,000 account you're starting with. You really should not be thinking of using a standard lot size. What you should be focusing on is a mini lot size, or perhaps even a micro lot size. That's if you have 1,000. But if, on the other hand, you have, say, 10,000, well, yes, you can then begin to think of using a standard lot size. But guess what? You are going to have to be quite good anyway. So even with $10,000 account, some might not even use a standard lot size. Perhaps they will wait until they have maybe $10,000 account before they start using a standard lot size. However, it is the case that a lot of Forex brokers would allow you trade, with a standard lot size, even though you have just 1,000. So it's for you to know. It's not really for them. It's not really up to them to help you manage your finances or your risk. It's for you to know that. That's why I see it as a very important thing to know about lot sizes and what to use. We have done lot sizes in the past. What they actually have. We've had a class on lot sizes in the past. But obviously we are teaching it differently now. We're taking it further. Lot sizes is, the lot size is the first thing, one of the first things that a Forex trader learns. 0.01, we're not going to go into details with that today, but I'll just quickly mention 0.01 is considered, as a matter of fact, anything between, let me just quickly draw this out. Anything between 0.01 all the way to 0.09 is classified as a micro lot size. Now, you can see what's going on here. 0.01, 0.02, 0.03 until it gets to 0.09. Then from 1 so you can see from 0.09 it jumps to 0.1. I know you might call it 0.10, but you know, this is basically what it is. So you might decide to put 0 here, but most people will not put 0 here, you know, even though we know there's a 0 there, which is just not appearing. So 0.1 to 0.9, if you like, in a sense, is what you will consider, you know, as 0.9 is what you will consider a mini lot size. You know, so we're basically looking at risk management today, risk management. Whereas a standard lot size would start from 1 all the way to infinity. I mean, if you like, I mean, I've seen people trade with 100 lots. So this 0.01 lots, 0.1 lots, 1 lot size. There's no decimal here. 1 lot size. You know, I've seen people, like I say, trade with 100 lot size. You know, I've not seen anybody trade with 200, 300, 400. I mean, come on. You must have billions if you are trading with that huge lot size. But anyway, you know, so this is basically what I want you to know today. You know, let's just write, you know, I'm going to be switching pages anyway. I'm going to be switching between pages here today. Let's choose a color here. You know, so we are calling this one of our risk management classes. We most likely would have, well, we definitely will be having other risk management classes. You know, but I want you to know, never mind my writing. Manage. How do you spell manage? Manage. Management. Okay, so this is our risk management class. Now, when it comes to risk management, we are looking at lot sizes today, how to, as a matter of fact, we're looking at how to use or apply lot sizes. You know, I would not call it a lot sizes class per se, you know, because we have looked at lot sizes, you know, like I just quickly, you know, gave you a brief idea of what different lot sizes are. Now, I will be giving you some homework anyway as well. You know, I have left, you know, a website, a popular website here before that you can also begin to use in brushing up your knowledge of Forex education. So don't just take the teaching from me, you know, on Sunday evenings. Always, you know, ensure you do your own further studies as well. Just like you do in school, in uni, you know, you basically have to go do some of your own homework. You know, I mean, if I must tell you this, I will say it very boldly and loudly. It is the case that when it comes to education, when it comes to, making progress, don't just, you know, stop at what your mentor or your teacher, your coach, or your educator teaches you or passes on to you. You need to seek more knowledge. You know, like I always say, there's nothing wrong in knowing more than your teacher. Oh yeah, I'm not in competition with you. There's nothing wrong in knowing more than your teacher, you know. And I always also say discovering things for yourself as well is also very important. It's an important way of learning, as opposed to something that was passed on to you by your mentor, your coach. You know, you also want to discover some things yourself, either by, you know, as you go on in trading, or as you do further reading and investigation, further research. You know, you discover some things, and some of the things you discover yourself are the things that I would likely not would likely stay with you even longer than, you know, what your mentor taught you. So always do some more education. So remind me, well, the link is in our VIP room anyway, Forex VIP room, so you would know. So we've done lot sizes in the past. Today we're going to be doing how to apply lot sizes. You know, it's so wonderful. We have different colors here, so beautiful. I don't feel like cleaning it, but as we move on to other screens today, this is going to have to disappear. So what I want us to do now is to, you know, now begin to do some, you know, calculations. Let's do some calculations here, guys. You know, perhaps you could say this is one of those classes that you would rather not do, or one of those classes you would rather not have, because we are going to require you to use your mathematical minds. We're going to provoke your mind mathematically. However, it's not going to be too deep. It's not rocket science. So do stay with me. You know, like I said, you know, in the VIP room, tonight's teaching is one that, you know, could make or break you. Okay, fine. I didn't say it like that. It could make or break you as a Forex trader. This is one of the things that would determine whether you stay long in the business. A lot of people come into Forex trading and they blow their account very quickly because, you know, they did not learn some things. And this is one of them. Okay, so lot sizes. Simply put, the lot size you apply in a trade is how much risk you are taking, how much you are risking per trade. Okay, so let's come here. You know, guys, I'm going to need you to work with me today. You know, please, I'm going to need you to work with me today, you know, in the sense that, you know, there are going to be times I require you to respond in the chat box, you know, as to whether you are seeing my screen, you know, when I switch to a different screen. I don't want us to miss anything, you know, here. Okay, so, okay, sorry guys, can you see my MT4? If you can see my MT4, type in 333. If you can see my MT4 chart, not my trading view, but my MT4 chart, marked up chart. If you can see, type in 333, please. Okay, thank you. Okay, so what we're going to do now, let me get a more naked chart. Okay, that's better. Thank you, thank you, thank you. So, you know, when you are going to open a trade, when you're going to open a trade on MT4 or MT5, you will come here. You click on that. You click on that, and then that is where you choose your lot size. Let me turn off my camera. Let me not distract you. So you will choose your lot size here. We know on the MT4 platform, it is known as volume, but we know that is lot size. That's your lot. So you can see here, as default now, it shows 0.50. It shows 0.50. Now, guys, you know, mathematically speaking, you don't say 0.50. That's wrong. I mean, in maths, it's not, you don't count the zero at the end. You know, you say 0.5. So that's 0.5 lots. When I opened this was what came up by default, because what will usually come out by default would be the last lot size you used, or the lot size you used for your last trade. So be very careful, you know, whenever you are wanting to take a trade, that you are choosing the correct lot size. Don't just, you know, don't just click on this, for instance, and click on sell or buy. No, make sure that the default lot size matches what you want to use, because you might not want to use the same lot size for every trade. That's important. So you can go on and change it here, click on the drop down and choose any of these. Guess what, guys? The default that came up was 0.5. There are times when a lot of traders have made this mistake before, whereby they are looking to trade with 0.05, which is smaller, but they end up going with 0.5. It's a common mistake. I mean, so be mindful of that. 0.01, 02, 03, 04, 05. And guess what? It jumps to 1.0. So from the micro lot sizes, it jumps to a standard lot size, which is a huge jump. Guess what, guys? You don't have to go with that, because you can type in what you want to trade with. You don't have to necessarily use the drop down. You can, if what you are wanting to use is not here, like for instance, the micros stop at 0.5, maybe you are looking to use 0.06. So you just type that in 0.06. You type in manually, and then you click on buy or sell or whatever you want to do. So be mindful of that. So yes. Now, like I say, these are the lot sizes. You can also see that it stops at it stops here at 8 lots, 8 standard lots. Maybe you are looking to use 9 standard lots or 10 or 11. So you just type it in 11 and you go with it. Guess what? If you type in a lot size that is way bigger than your account can accommodate, the execution would not execute. Your trader platform, your MT4 would not execute it. I suppose that's a safety measure. I mean, if for instance you have a $2,000, if for instance you have a $100 account and you are typing in 10 lots, it will give you an error message. Let's just try this. Let's just try this. Let's just try 200. Okay, this is pound USD. So we know pound USD is not open because that's a forex pair. Let's look for a pair that is open today, and that would be a crypto pair. Let's look for XRP. XRP, where are you? XRP. Okay, so let's try and type in 100. I hope this account will not take it. Let's try and type in 300 lots. And let's see what error message comes up. If it takes it, then this account might be blown if the market goes in the wrong direction. Okay, let's do a buy. 300 lots, 300 standard lots. So you can see it says not enough money. So that's a good safety feature which the brokers have put in place. If I was to use one standard, I'm sure that would definitely go. One standard. You can see it has taken it, because this account has, I think it probably has, close to 15K in there. So if we do this, anyway, let's just, let me just put a stop loss here just in case I win this trade. I didn't analyze it. I just entered just for practice sake. Anyway, I'll just leave that. Okay, so that's basically one of the things you need to know about lot sizes. What else do you need to know about lot sizes, guys? I'll tell you, because we're talking of how to apply lot sizes, the lot size to use. You don't want to be using a lot size that is way bigger than you ought to use. Why? Because you want to be able to stay in the trade longer. Like I was saying a while ago, when we talk of lot sizes, we are talking of the percentage of your account you are willing to use. I'm sure you've heard a lot of traders before tell you that it should be 2% per trade. You should be risking 2% of your account per trade. What does that mean, guys? Very simple. It basically means if, for instance, you have a $100 account, you really want to be using no more than $2. So what I'm saying is, the advice really is that you should use a maximum, not compulsorily it's not compulsory that you use 2%, but it is advised that you should use a maximum of 2%, in this case, which will equate to $2, which means you are risking $2. If you have an account of $1,000, you use a maximum of 2%, that will come to $20. So basically it means if you lose that trade with this account, you are not going to be losing more than $20, which means you've just lost 2% of your account. You still have the remaining 98%, or in this case, you still have $980 to go. Now, let's get ridiculous. Let's try and get ridiculous so you get the picture. Sometimes, you need to get ridiculous. You need to do or say the ridiculous for people to grasp what you're saying. Okay. How about this one? You have a $100 account. A lot of traders start with $50, $100. On average, I would say about $250. I know that's probably even less. On average, majority the average trader starts with about 200 or 250. Like I say, it's probably even less, but let's just work with that. So if a trader starts with $100, for instance, and say a couple of us start with $100. I start with $100, and Ikeoma starts with $100. Ikeoma, by the way, I've not seen that name here before. Kindly, type a message and let me know what you are otherwise known as in the Telegram group. I need to know that it's mainly our VIP members here. Well, only our VIP members, because that's what it is. This class is for today, our VIP members only. So Ikeoma, type in your name in the chat box. Let me know who you are. Okay, so let's say myself and Marianne, enter a trade and we open a Forex account with $100. I decide to go in with 2% of my account for the first trade, which if I lose $2. Now Marianne is feeling all excited. She wants to hit the jackpot. She wants to make some mega bucks in her very first trade. And she decides to risk 50% of her account. Oh, Marianne, it doesn't work that way. Oh, it doesn't work that way. I am here risking 2%, and Marianne, for some reason, comes in risking 50%. Which means if that trade goes against her, she's going to lose not just $2, but she's going to be losing, we know, $50. If she decides she's going to be risking 50% of her account each time she trades, with a $100 account, it means she's only going to be able to take 2 trades as the maximum if she loses. So it means if she loses those 2 accounts, the account is blown straight away. She's blown the account. So I'm sure you can see now why you want to limit your risk to a maximum of 2%. It will keep you in the game for way longer. I mean, this is something that professionals have worked out, have come up with. Hey, you want to go with what the professionals have come up with unless you can prove them wrong. And so far, I have not been able to, go against that advice. 2% per trade, maximum. Now, what does that tell us? It basically tells us that you can even use something less. Maximum is what I said, maximum, which means you can decide to risk 1%. Meaning, if you lose just 1% per trade. If you are risking 1% per trade, you would stay longer in the in the market than somebody who's using a larger percentage, someone who's risking more. That's basically where the lot size, the idea of the lot size comes in. That's where the idea of the lot size comes in. That's where this whole thing about the lot size comes in. The lot size you use matters a lot. The lot size you use matters a lot. I'm going to be showing you something else now. Okay. Pastor Chooks. You can call me K. Okay. Okay, I'm wondering if that's the Pastor Chooks. I only know one Pastor Chooks. Okay. Anyway, let's go on. So this is basically what it is. Lot sizes. Let me show you something else. We're going to be taking some questions anyway, but let me show you something else before we go. This is our popular website, not the GWT website, of course, but the popular Forex website out there. It is very well known among, Forex traders. It's something that we always reference. Okay. Now look at, they've done some tabulation for us there. They've done some tabulation for us. They've given us the ridiculous. I gave you something even more ridiculous a while ago. Risking 2% as opposed to risking 10% per trade. Now, assuming you start with a $20,000 account and you risk 2%, that would amount to 400. If somebody else risks 10%, that's 2,000, which basically means if you lose 10 consecutive trades, you are out. And guess what? That is not an uncommon thing among Forex traders, newbie traders. Okay, let me correct that. That's not quite true. Because in Forex, guess what? There is also such a thing as the beginner's luck. Just picture me laughing. There is such a thing as the beginner's luck. Sometimes your very first trade, boom, you hit it big. And you think, my goodness, where have I been? You mean this is what Forex traders do? This is how they make money? And I didn't know this? It could just be beginner's luck. If you don't have any strategy, if you don't have any risk management, in place, you don't have any money management strategy or technique in place, that is perhaps just sheer luck. And guess what? Luck will not keep you very long in the game in Forex. So you do need a strategy. You need an entry and an exit strategy. You need money management strategy, risk management strategy. You need to have a good trading psychology, and a whole lot more, if you are going to be profitable in Forex. So they basically, I'll post this link. Let me just post it now anyway. I'll post it in our room so that you can pick it up from our VIP room. I'll post it in our VIP room. So by the way, this is what we looked at some time ago. It's also about risk management. If we have time, I'll kind of like briefly touch on this. We looked at it last time, but not today. So we're looking at, we want to make this thing comprehensive, guys. If it's not comprehensive, there is no way you are going to be better than me as a Forex trader. If I do not, pass on to you what I know, believe me, it's going to be difficult. Some of these things I learned many years into Forex trading. Can you believe that? Why? Because I did not have a mentor as such. I just learned some of these things that I should have learned the very first couple of months or weeks. I learned them years after. And that's the case with a lot of Forex traders. But anyway, let's not dwell on that. Come on. So we see the table here. If you start with 20,000 and you're risking 2, it's going to take a lot more. It's going to take a longer time to blow your account, even if you're having a losing streak. I was talking about a losing streak just now, or that's what I was about to talk about. It's not uncommon, even for professional traders, to have a losing streak. Now, okay, is that quite true? Okay, let's just leave it anyway. But what I am saying is, it's not impossible, it's not uncommon for even those who have been trading for some time to have a losing streak. That is loss after loss after loss after loss. It's like sometimes, like, no matter what you do, it's as though somebody in the market is just watching you in the spirit, monitoring you. It's like whenever you place a buy, they push the market and they push it down. Whenever you place a sell, they push it up. It's like, hey, what's happening? Are the gods against me or something? But people do have losing streaks in Forex as well. So if you have a 20,000 account and you are placing 2% risk per trade, it's going to take you a whole lot longer to lose or blow your account than this person. This person, because they are placing 10% per trade, it means after 10 consecutive losses, they are out. Whereas you will still have up to 50. Well, this person would have at least 50 trades. You have to lose 50. Now, if anybody loses 50 consecutive trades, guess what? They probably have a gambling mentality and they should stay away from the computer, not just the Forex chart. They should stay away from the computer altogether, or their phone, so that there's no temptation to even trade. You shouldn't lose 50 consecutive trades. No, that should not happen. But hey, this is just, something to give you an idea of what can happen. Let's go back here. Okay, this trade has closed. Let me see if I don't think I won it. Let me see. Whether I won it or not, anyway, you can't judge me. It was just a trade we entered. The aim was not to prove or show. The aim was not to prove or show my skill. I lost it. I lost that trade. Anyway, guys, it's a demo account, so I just lost $153 there on demo. Okay, if it was not demo, I wouldn't trade that anyway. Okay, so basically, coming back here, coming back to the chart now, we're going to just look at this, and then we would, take questions and answers. We'll take questions and answers. Okay, so look at this. This is pound USD on the 15-minute time frame. Like we always say, Okay, people are already typing in questions. Just give me some minutes. I would answer them, don't worry. Okay, so we see what's happening with this pair here. It's basically, let me put this up. So this was Friday's trading session. The market is closed. The market will open, say, in about 2 hours time. I'm sure you guys know that Forex market is open like 5 days a week, or maybe 5.5, depending on where you are. I mean, for us, the market will start in about 2 hours, whereas those in the East Coast in America, it would be 5 o'clock. For us, it would be 10. For them, it would be 5. So, I don't know how you want to work that out, but anyway, that's the way we see it. So this was Friday's trade. This was Friday. This was Thursday. Anytime you see these lines on a chart, it basically tells you it separates one period from another. In this case, it's separating this line to this line is 1 day. This line to this line is another day. So this was Friday's market. That was Friday's market. So what happened on Friday? We see here the price opened, the day opened here. This was around about 10 in the evening on Thursday night. And the market went up, did a zigzag all the way up, and then it dropped. And then from here, it pushed up. I think this was the NFP, non-farm payrolls. You can always check it up on the internet. Just do a Google search, NFP, type in NFP Forex. It's one of the biggest days in the market, in the Forex market. So the price, I'm sure this was the NFP move, this move up, it pushed the price up. Guess what happened, guys? Guess what happens if you want to measure by how many pips the market moved on Friday? We would take the highest, that was the highest, that the price got to on Friday. That was the highest the price the market got to on Friday. Right here. So that was the highest the market got to on Friday. And this was the lowest it got to. That was the lowest the market got to on Friday. How many pips is that? So we'll say, if we measure it, we'll see that from here to here was about 93 pips. So the market moved by 93 pips on Friday. Like I've always said, for those of you who are new here, in market movement is measured in pips. In Forex, the market movement is measured in pips. Whereas if you are traveling from London to Birmingham, or from Lagos to Abeokuta, you will measure it in miles or kilometers or whatever else. But in the market, you measure it in pips. So we see that the market moved by about 90 something pips, and each pip matters. Each pip matters, because if somebody bought here because they anticipated the price of the dollar was going to go up against the price of the pound was going to go up against the dollar, if they bought it here, they were right. They were bang on. They caught it at the very low of the day. They caught it cheaply, if you like, and took it all the way up. It doesn't matter, even if you didn't take it all the way up, even if you sold here or sold here, you still made some money. Now, for some others, they would have taken the price all the way up here, and when it began to come down, they would have sold quickly. Don't want to give too much back to the market that they've already gained. So, but the market moved about 93 pips. Now, assuming you entered here, from what we said earlier on, we did show you that 0.01 lots, that's micro lots, equals 10 cents. 0.1 lots equals $1. And 1 lot size equals $10. Let's assume that all of us here are big boys and big girls. We've got the word. We started our account. We started our Forex account with $10,000. So we are trading. Okay, to make it easy, I don't want to get myself entangled. Let's assume we started our account with $1,000, and we decided we're going to trade with mini lot sizes, not micro, not standard, because standard would be too much for our account. Micro, maybe you don't want to undercut yourself. I mean, you could trade with micro. You could decide to trade with 0.09. Yeah, you could do that. But let's assume we started with $1,000 and we want to go with trading with a mini lot size or mini lot sizes. So you enter with 0.1. It could be any lot size, any mini lot, but let's start with 0.1. It basically means if the market moved by 93 pips and you cut all 93 pips, you've just made $93. Because you enter with 0.1, which is equal to $1. So it means that whenever the market moves by 1 pip, that's a $1 move. If it goes by 2 pips, 3 pips, 4 pips, 5 pips, that's a $5 move, because it's 0.1 per pip. I don't know if I mentioned that earlier on, but I'm making it clearer now. So this 0.1 is 0.1 pip. And guess what? That is in either direction. So if you bought and it's going up, you are making money. If you bought and it's going down, you are losing money. In Forex, if you anticipate, if based on your analysis, you gather the price is going to go up, you buy. If you gather it's going to go down, you sell. Oh yeah, and I'm sure some of you would know, maybe others might not. We make money in Forex whether the price is going up or down. It's just you have to be on the right side of the market. So if you bought and it's going up, think of it, note this, if you bought and it's going up, you make money. If you bought, on the other hand, is going down, you say it's going against you, the market is going against you, which basically means you are losing money. So we are going to go with the scenario of us gaining, getting our analysis right here. So we bought and the market was going up. So it moved by 1 pip, 2 pips, 3 pips, 4 pips, 5 pips. Because we enter with a lot size of 0.1, which is equal to 1 pip per move, we just gained 5 pips. Now, if on Friday it did 93 pips and you cut all 93 pips, which is most likely not going to happen because, most people would, take some pips and, be out, or they will come out when the market begins to retrace against them. Like I did show here, assuming you got it from the beginning here and it went all the way up, all the way up, all the way up, you are anticipating it's going to carry on going up, but then it begins to go down. Guess what? You decide to come out here. So let's say you entered here, it went up, you were screaming with joy, punching the air, excited, 93 pips, but began to go down. And by the time it got here, maybe close to the close of the market session, it was now 70-something pips. You are giving back about 20 pips. You came out. So let's assume you closed the day with 70 pips. So if you closed the day with 70 pips, you just gained $70. If you entered with a standard lot size, which is 10 pip per move, with a mini, it's 1 pip per move. Sorry, $1 per move. With the standard, it's $10. So with the $72 you ended up with, it means you made $720. So you can see, guys, why it is the case that, we could go into the market. There are lots of people in the market. There are, a number of us here today. Some will go in with micro lot size because they have a small account. Others will go in with mini. Others will go in with standard lot size. Even though we all captured 72 pips, we will all end up with different monetary gains because of our lot sizes. So that is what to note. So I'm going to be pausing it here, for us to take questions, which obviously means I'm going to be, stopping the recording. Yeah, I'm going to be stopping the recording, because I'm recording it, directly on YouTube, even though it's not for the public. But so get ready, guys, to take your questions. And before we do that, we'll take a 5-minute break. When we come back, we would I'll take your questions, and obviously that will mean a bit more teaching. So we would